good evening, Governor Rolle, Deputy Governor Rolle, ladies and gentlemen. It's my pleasure to serve as this evening's moderator and welcome you to this lecture series titled Striking the Balance Between Regulation and Encouraging Innovation. We have an exciting lineup of speakers who are all seasoned central bankers and professionals with years of experience and indeed qualified to speak to you on this topic. To begin this series, I briefly introduce them in the order in which they will speak, and following the last speaker, I will return to start and lead off the Q&A session. Firstly, we have Ms. Karen Rolle, who is the current Inspector of Banks and Trust Companies, with responsibility for financial sector supervision for financial institutions, falling under the remit of the Central Bank of the Bahamas. Next, we have Mr. Culmer, who is the Deputy Manager of the Policy Unit within the Bank Supervision Department. Mr. Culmer is responsible for developing policy guidelines and legislation in collaboration with the bank's legal unit to ensure that the bank's regulatory environment complements and complies with international standards. And finally, we have Mr. John Moncur, who is an information technology examiner and subject matter expert in the area of technology risk and leads IT-related on-site examination. I now turn over things to Ms. Rolle, who will move into our presentation.
Thank you very much, moderator. Good evening, ladies and gentlemen. It is indeed a great privilege for my colleagues and me to be a part of this momentous 50th anniversary lecture series as presenters on what I dare say is quite a stimulating topic. I wish to acknowledge the presence of Governor Rolle, Deputy Governor Rolle, directors on the Board of Central Bank, various heads of department at the Central Bank, other distinguished officials and invited guests, and also my colleagues across the bank, particularly Bank Supervision Department. I also wish to thank the 50th Anniversary Planning Committee for organizing this event as part of the Central Bank's collective efforts to fulfill its strategic objective of engaging the public by providing them with an insider's lens into how our role affects their everyday life. Lastly, I wish to thank my fellow panelists, Mr. Culmer and Mr. John Moncur from the Bank Supervision Department, who I am pleased to have joined me in unraveling such an exciting and timely topic. So the Central Bank's 50th anniversary has provided us certainly with an opportunity to reflect on how the Central Bank has evolved as an organization and how it continues to pivot by building a strong regulatory architecture that promotes financial and operational resiliency within our financial institutions, especially in the age of increased digitalization and technological advances. This evening, my colleagues and I will be dissecting the topic, striking the balance between regulation and encouraging innovation. Some may say that there is a dichotomous relationship between innovation and regulation. Well, let's explore this statement by understanding the basic meaning of these words, in innovation and regulation. Innovation is defined as the process of bringing about new ideas, methods, products, services, or solutions that have a significant positive impact and value. It involves transforming creative concepts into tangible outcomes that improve efficiency and effectiveness or address an unmet need. Regulation, on the other hand, simply put, are rules or directives made and maintained by an authority that establishes parameters or guardrails for permissible structures or activities. During this brief lecture this evening, my colleagues and I will be addressing why innovation and regulation are both important and are vital to financial sector development. Innovation is indeed the gateway by which products and services are delivered to meet or exceed customers' expectation. While regulations set out the parameters to facilitate innovation and the guardrails to ensure that the risk associated with innovation is measured and controlled in order to protect the end user. This is where the role of the regulator steps in to create that balance. The regulator never wants to develop a regulatory framework that is too light touch, that we do not understand the downside risks of when things go wrong. In this vein, regulators are naturally skeptics and are incessantly concerned about what can go wrong and that can impact the safety and stability of the financial system. This behavior is not because we dislike innovation, but because we want to know that because we know that the public is counting on us to have done the proper due diligence and risk assessments for any new products, services, or operational enhancements that will have a significant impact on the public. On the other hand, regulators do not want to be accused of stifling innovation with heavy-handed draconian rules that result in overregulation or regulatory burden to the point that compliance cost of innovation outweighs the financial benefit to the institution. It is important to note that regulation requires progressive and robust legislation that authorizes the conduct of business by regulated entities. The legislative framework must be specific and intentional, open to advancements but appropriately restrictive, clear and unambiguous, yet flexible enough to support business growth and development. While our topic this evening focuses on regulation, it's important to note that regulation is only as effective as the quality of supervision. While regulation concerns the drafting and implementation of rules governing the activities of the financial system, supervision is about ensuring that financial institutions comply with the regulatory framework and imposing sanctions on those institutions that do not abide by the rules and the regulations. Supervision requires balancing the technical knowledge and understanding of the business of the regulated entity while applying global minimum standards and principles that level the playing field for fair and healthy competition. In applying these minimum standards as a supervisory authority, we must take care to foster an environment conducive for the economic development that benefits our jurisdiction. Crucial to economic development is how innovation is nurtured and encouraged. This requires us to weigh the benefits of a product, service, or delivery channel against the risk posed to the financial system. This analysis is an embedded part of the central bank's risk assessment of all our supervised financial institutions, and it feeds into how we determine our risk view of the financial institution and the intensity of our supervision. So it's important to point out that having a robust regulatory framework that is enforced by timely and effective supervision engenders confidence in the market and allows innovation to thrive. Regulated entities that fall within the supervisory purview of the central bank, such as banks, credit unions, payment service providers, and money transmission businesses, consider the regulatory and supervisory environment in which it conducts business and perform the necessary cost-benefit analysis to determine whether it's feasible to continue to do business as usual. Investment in advanced technology has opened the garment in which regulated entities interface with their collective customer base. With the implementation of these advanced technologies, this adds to further to scope in which the central bank must continue to remain on the cutting edge to anticipate the impact that it could have on the financial system. I wish to touch briefly on the banking sector in the context of innovation. From a global perspective, the traditional banking model is fast becoming a relic of the past as banks are making strategic shifts and partnering with digital services providers and non-banks. Advancement in technology have allowed great opportunities for banks to provide new banking models, services, and products, which have helped to revolutionize how financial services are executed and supported. These strategic shifts are clearly more evident in advanced economies, but we have witnessed the evolution in banking in our own domestic context. Yes, we have seen it and lived through it. Gone are the days of the old passbook and unlimited in-branch customer services. In fact, some of us may recall that accompanying your parents to the bank on a payday was an official family outing in the good old days. Now, human interaction have almost been entirely replaced with smart ABMs, laptops, tablets, and mobile devices once you have internet connectivity. Fintech solutions have helped banks to become more competitive by increasing their value propositions to customers. I use banks as an example as it provides a clear reference as to how, over time, innovation through technology has transformed our lives and banking experience. Since the recent pandemic, commercial banks, including those in the Bahamas, have been more intently focused on various digital transformation initiatives aimed at reducing in-branch services, which are now easily accessible through other modalities. Innovation is, of course, is not without growing pains. While banks may know the benefits and what can go right and having the strategic partnerships with fintechs, the question remains, are they satisfied that they have done a thorough risk assessment to determine what can go wrong, and they have formulated the appropriate risk mitigating strategies? The central bank, like regulatory agencies the world over, is faced with the balancing act of how it responds to market innovation while carrying out its mandate to ensure a safe and sound financial system. Assets that were once physically protected are accessible online. Services, delivery channels, and distributions that were once that are now outside of the control of the banks are now vulnerable to disruption, intentional or unintentional. Bad actors may have increased opportunities to exploit the weaknesses in financial technologies that can lead to theft, fraud, and misuse of sensitive information. As financial institutions evolved their business models and delivery channels, the central bank became more intentional about its rulemaking around technology risks, operational resiliency, and stakeholder communication and disclosure. In fact, we are now in the process of assessing our guidelines against the recent set of reforms issued by the Basel Committee in its final published version of the Basel Core Principles released in April 2024. And for your knowledge, the Basel Committee is the international standard-setting body for the banking sector, the banking community. Later on, you will hear from one of my colleagues on a consultation paper soon to be released by the central bank on a framework for sandbox. And essentially, a sandbox is a regulated ecosystem to permit existing or new market entrants to test new innovative products and services in a controlled environment until it's proven to be market ready. Hopefully, I have set the stage for why the central bank must ensure that there is an appropriate balance between innovation and regulation. Culmer will now address some of the considerations that form part of our regulatory strategic objectives and the central bank's efforts to respond and remedy the challenges associated with them. Thank you.
Good afternoon. Sorry, good evening. The central bank, in its role as a supervisory authority, is committed to effective regulatory and supervisory oversight that assists with our understanding to assess the risk associated with financial services innovation. Of course, we must ensure that there exists, firstly, a progressive legislative and policy framework, along with an open environment to facilitate market growth and innovation. Secondly, supervisory oversight encompassing a licensing and registration process, supervisory tools, and enforcement measures. Thirdly, there must be mechanisms supported by legislation and regulatory oversight that outline consumer and investor protection. And lastly, and of course by no means least, there must be robust risk management by all players in this space. As outlined within our technology risk management guidelines issued in 2016, advancements in technology have allowed great opportunities for licensees to provide new banking models, services, and products. Social media, internet banking, and mobile technology all have helped to revolutionize how financial transactions are executed and supported. However, with this evolution of enhanced services, the financial sector has also introduced a sophisticated and complex set of vulnerabilities and security issues. And I will dare to quote our inspector again, but our technology risk management guideline says that assets that were once physically protected are accessible online. Channels are vulnerable to disruption, intentional or unintentional, and criminals have new opportunities for theft and fraud. Exploitation of weaknesses in such technologies can lead to theft of intellectual property and other sensitive economic information. Now, of course, the sentiments remain virtually unchanged since 2016 when these guidelines were issued, except for the increasing number of service providers and non-banking institutions seeking to disrupt the traditional mechanisms in order to provide platforms for regulated services to be offered to clients. The central bank has acknowledged certain challenges not unique to our jurisdiction as key strategic objectives that require its supervisory intervention. The common thread critical to these challenges revolve around the need for near ubiquitous access to financial services and providers by all Bahamians in order to conduct everyday financial transactions. This challenge has been recognized as the pursuit of financial inclusion, wherein efforts should be made to ensure that financial products and services are accessible and affordable to all individuals and businesses, regardless of their location, personal net worth, or company size. Therefore, access to financial products and services are crucial for developing countries like the Bahamas. While traditional banking institutions were sometimes seen to be conservative in their offerings to clients, competition has always nudged them in the direction of adopting incremental technological changes to satisfy their evolving client base. This evolution was pointed out by Inspector Rolle, where the good old days of planning an entire day around your banking activities to now today's real-time digital transactions that facilitate transfer payments, deposits, and withdrawals from any internet-connected device. The objective of ensuring access to financial service providers has driven non-bank service providers to develop technological capacity to fill in the gap where access to financial services and their providers are either limited or non-existent. The advancement in financial services-driven technology, now referred to as fintech, has now provided opportunities for service providers to engage consumers directly through innovative platforms. As a central bank, we saw the need to fulfill the objective of financial inclusion with the development of our very own central bank digital currency, the sand dollar. As part of the modernization of the payment system, the sand dollar is seeking to make the payment systems more efficient and non-discriminatory across our archipelago of islands, with primary goals of universal access to banking services of a deposit account maintenance nature. Secondly, a reduction in the size of legitimate but unrecorded economic activities that take place in the informal sector. Full admission of micro, small, and medium-sized businesses into the digital space, and 100%, hopefully in the near future, of the population having access to the digital payment services. Several of our regulated entities, such as money transmission businesses and payment service providers, through the development of their through the development of their digital wallets, have aided in the expanding use of the sand dollar. As an aside, while I have briefly mentioned our objective of financial inclusion in this lecture, there is a scheduled lecture later in the year to fully discuss and explore the initiatives the central bank has been a part of and intends to do to address this ongoing challenge. However, as a supervisory arm charged with the responsibility of entities such as PSPs and MTBs, we must ensure that the fitness and propriety of the principles, technological capacity of the operational system, and material reliance on third-party service providers receive the appropriate risk assessment based on their nature, size, and complexity. These risk assessments form a critical part of our supervisory framework, which drives the breadth of our supervisory oversight. While our efforts towards achieving widespread financial inclusion will remain a key strategic objective for us to achieve in the short run, we recognize that the licensing and authorization process forms part of the first line of defense in which financial innovators may receive approval to conduct business in our financial system. Regulators seeking to provide guidance to non-financial entities who wish to enter into the financial services system and offer fintech solutions have deployed several innovative supervisory tools, such as innovation hubs and regulatory sandboxes, to which the central bank has embarked on exploring the latter. Tools such as regulatory sandboxes have the capacity to act as an extension to our licensing and registration process to approve licensees in allowing service providers introducing new and innovative technologies into the financial services system. As such, what this does now is provide a path for companies that offer elements of traditional financial services through non-traditional means and acts as a forum to engage the regulator and receive non-binding guidance on how its financial products, services, business model, or delivery channels will conform with licensing and regulatory requirements. While developments in this area are ongoing, it allows the central bank as a supervisory authority to facilitate a strategic entry point conducive for innovation and market growth. And as you can see, some of the key characteristics of a regulatory sandbox are that it allows live testing, where firms, applicants get to test their product services with real consumers if they're existing licensee. Supervision, where they have non-binding guidance from the central bank within a limited time frame, usually no more than a year. And of course, there are restrictions and consistent reporting during this process. And so what this does in terms of creating the sandbox environment, we guide potential licensees, because we call them potential at that point, to the possibility of entering into the financial system. In this regard, we have completed a consultation paper discussing the implementation of a regulatory sandbox. The paper outlines our intent and its proposed structure, identifies challenges given the current regulatory environment, and it asks questions where we appreciate honest and frank feedback from the public. So, of course, I encourage you to stay tuned for the release of the consultation paper in a week or two. We anticipate that employing tools such as the regulatory sandbox, fintech innovators and service providers will explore the feasibility of introducing global concepts that expand digital banking services and formally introduce fintech-driven concepts such as agency banking. The central bank acknowledges the retrenchment of physical branches on the Family Islands, whereby the brick-and-mortar banking relationships and establishments have proven to be costly for banks to maintain. Traditional banking supervised financial institutions find it costly to operate branch operations for sparsely populated islands and keys that require access to financial products and services to meet operational demands. Now, of course, while this is a valid rationale, it is still an obvious fact that Family Islands are left bereft of basic services and are greatly inconvenienced when needing to facilitate the most basic of daily payment activities. Now, while online banking may address some of their needs, the need for cash-based services is still a strong part of the operating environment on the Family Islands. With an intimate understanding of our structure, the central bank is seeking to address financial inclusion needs on the family of islands in two fronts. As stated earlier, the launch and continued growth of the sand dollar, which formally satisfies digital cash payments for those considered unbanked. And secondly, introducing an enabling framework for agency banking. In this regard, commercial banks and other regulated entities will be able to exploit new technologies and explore fintech relationships to address the needs of banking services on the Family Islands. The central bank acknowledges that agency banking in developing states introduces non-banking entities to critical consumer data needed to initiate and maintain relationships. Agency banking, like many other fintech-related products and services, introduces a complex set of vulnerabilities and security issues when third-party service providers participate in the space. Banks and other supervised financial institutions must ensure that these third-party service providers adopt sound business practices and will not jeopardize the security and integrity of the financial services system. John, in his contribution, of course, will further discuss the risk associated with these innovations and the supervisory tools we exercise to continuously assess the risk and controls SFIs must employ to offset the vulnerabilities and security issues that may arise. Notwithstanding our efforts to introduce innovative supervisory tools to advance innovation, our regulatory and legislative framework must remain responsive and progressive to facilitate this level of innovation occurring within the financial services sector. As such, our supervisory team regularly collaborates with our legal unit to ensure that our legislation remains robust to support both our progressive initiatives and enforcement actions that respond swiftly to actors and their activities that breach approved regulated activity. Most recently, the Central Bank has advanced amendments to the Banks and Trust Companies Regulation Act, Money Transmission Business, Payment Systems Act and Regulations, and pending amendments to the Bahamas Cooperative Credit Unions Act, which aim to achieve and streamline the bank's regulatory oversight over its licensees, amends the definition of electronic money, money transmission service provider, payment institution, and payment service provider, and expands the scope of regulation to include persons appointed as an agent by a bank or bank and trust company. The Central Bank anticipates that these legislative amendments will continue to support the innovation and economic growth we all desire. Additionally, as John outlines the way forward for supervising such entities, having a robust legislative framework will continue to strengthen our capacity to appropriately pivot our supervisory, monitoring, and oversight. Thank you.
Good evening. It is a pleasure to join my esteemed colleagues to address you this evening on a topic of importance in our rapidly evolving financial landscape, both globally and locally, striking the balance between regulations and encouraging innovation. I re-emphasize that as a banking regulator, this balance is crucial to ensure financial stability while fostering the growth and development of new technologies and business models that can drive our economy forward. Given that this is a global challenge to all regulators, I will speak generally at times from a global perspective and add appropriate local jurisdictional context on the technological developments that should contribute to our policy responses to this dynamic dichotomy, and at a very high level with the given time constraints. Technological advancement in financial services and fintech providers have dramatically transformed how financial services are delivered. As expressed throughout our presentation, these innovations bring numerous opportunities such as improved financial inclusion, enhanced efficiency, and increased convenience for consumers. However, they also introduce potential risks to consumers, investors, and the broader financial system that we must diligently manage. I would like to use a characterization of fintech proposed by the Financial Stability Institute, the FSI, where the fintech environment can be visualized as a tree with fintech activities like digital banking, crowdfunding, robo-advice, and crypto assets forming the treetop. It is useful to note that the responsibility for regulating these activities may in some jurisdictions like ours be shared among multiple national regulators, adding to the existing requirement for cooperation, communication, and coordination between regulators. These activities are enabled by technologies such as cloud computing, artificial intelligence, AI, application programming interfaces, APIs, and distributed ledger technology, DLT. Apologies for the jargon. So these technology enablers are the trunk of our tree. At the roots, we find policy enablers, including digital ID systems, data protection frameworks, and cybersecurity measures which provide the necessary support for these innovations to thrive. Our primary challenge is to maximize fintech's benefits while minimizing its associated risks. This, however, is easier said than done. The rapid pace of innovation often outstrips the ability of regulatory frameworks to adapt, potentially leaving gaps in oversight. Moreover, fintech developments can introduce trade-offs between different policy objectives, such as financial stability, market integrity, consumer protection, and competition. A critical aspect of fostering innovation while ensuring robust regulation lies in the effective implementation of these technology enablers. These enablers, which are the trunk of our tree, form the backbone of the fintech ecosystem and include, number one, cloud computing, which offers scalable and flexible infrastructure that supports the rapid development of fintech solutions. It reduces costs and enhances the ability of financial institutions to manage large data sets efficiently. Regulators must ensure that cloud services comply with data protection and cybersecurity standards to mitigate risks associated with data breaches and service disruptions. Recent events have demonstrated the widespread impact that can be potentially systemic posed by the disruption to a major cloud service provider. Number two, artificial intelligence, AI, and machine learning technologies are transforming risk management, fraud detection, and customer service in financial services. These technologies enable more accurate credit scoring, personalized financial advice, and automated customer interactions. Regulators like ourselves need to establish frameworks that ensure the ethical use of AI, prevent biases, and maintain transparency in AI-driven decision-making processes. The use of AI also introduces additional complexity and add challenges when we look to audit or to look back at decisions, at the information which supported historical decisions. And it can certainly present a challenge from an examination perspective when we go in to see, reperform, and re-examine based on prior information, given the complexity in the interlinkage components. APIs, number three, are crucial for fostering innovation and enhancing interoperability in financial services. They enable different software applications to communicate with each other, facilitating the seamless integration of third-party services into banking platforms. Open banking initiatives, which leverage APIs, allow customers to share their financial data with third-party providers, leading to more personalized and competitive financial products. Regulators must ensure that APIs are secure, standardized, and promote competition while protecting consumer data. Four, distributed ledger technology. A popular example is the blockchain, offers secure and transparent methods for recording transactions. It has the potential to revolutionize areas such as cross-border payments, supply chain financing, and identity verification. Regulatory frameworks must address the unique challenges of DLT, including interoperability, standardization, and legal recognition of digital records. Number five, biometrics. Enhance security and convenience in authentication processes. Technologies like fingerprint scanning, facial recognition, and voice recognition are increasingly used in mobile banking and payment applications. Regulators must ensure that biometric data is protected against misuse and that systems are resilient against spoofing and other security threats. To support the responsible growth of fintech, we must also focus on the policy enablers, the roots, particularly on the areas of data protection and cybersecurity. Firstly, data protection frameworks. Robust data protection regulations are essential to ensure that consumers' personal and financial information is handled securely. These frameworks should enforce strict controls on data collection, storage, and sharing, ensuring that consumers have control over their data. Privacy laws like the General Data Protection Regulation, GDPR, in Europe has set the current high standards for data protection, serving as a model for other regions to follow. And I am hopeful that updates to our own Data Protection Act circa the early 2000s are progressing to adequately keep pace with the changing environment. Secondly, cybersecurity. With the increasing reliance on digital platforms, robust cybersecurity measures are essential to protect the financial system from cyber threats. Regulatory frameworks should require financial institutions to implement comprehensive cybersecurity strategies, including, once again, regular risk assessments, incident response plans, and employee training programs. Our technology risk management guidelines, though issued in 2016, are still useful in this regard, with imminent updates planned based on emerging risks, inclusive of the previously mentioned technology enablers. Collaboration between public and private sectors is crucial to enhance cyber resilience and share threat intelligence. The continued development and implementation of the National Cybersecurity Strategy, along with the National Cybersecurity Incident Response Team component, CERT-BS, serves as a useful foundation for sector-specific collaboration. Thirdly, digital ID systems. Effective digital identity systems are critical for secure and efficient financial transactions. These systems help mitigate fraud and streamline customer onboarding processes. Regulators should promote the development of secure, interoperable digital ID systems that provide reliable verification methods while protecting user privacy. And fourthly, just on innovation facilitators, further to the details about and our plans to consult on regulatory sandboxes by my colleague Carl Culmer. More broadly, innovation facilitators include the regulatory sandbox, innovation hubs, and accelerators, and they provide safe environments for fintech companies to test new products and services under regulatory oversight. And just stressing the benefits to regulators, these initiatives help us understand the emerging technologies and their implications while promoting innovation. And as is typical, I think in our role as regulators where we have international collaborators, there's some good examples on the benefit of that from the UK's Financial Conduct Authority experiences with sandboxes. Given the global nature of fintech, international cooperation, as I mentioned, is crucial. Regulators must work together to address cross-border risks and ensure a coordinated response to global challenges. This includes harmonizing regulatory standards, sharing best practices, and developing frameworks for the supervision of multinational fintech firms. Organizations such as the Financial Stability Board, the FSB, and as Karen has touted, the benefits of the BCBS, play pivotal roles in fostering international collaboration. Consultation and engagement with licensees continue to be key components of the Bank Supervision Department of the central bank's activities prior to any significant supervisory initiative. Accordingly, the central bank conducted a survey in the second half of 2023, and the purpose was, one, to identify areas of technology risks from the deployment of recent or emerging technologies or practices by supervised financial institutions, SFIs, and two, use the information provided in updating the current technology risk management guidelines. Analysis of responses submitted from all respondents indicates sufficiently significant regulatory deployment or imminent plans to do so in the area of emerging technologies, including the use of cloud-based services, APIs, and the use of artificial intelligence or machine learning tools. So we have basic confirmation of the deployment of technology enablers in our own jurisdiction. Analysis of responses from all responses in the area of cyber resilience to mitigate the key risks from these technology enablers suggests opportunities for further focus and emphasis on policies and procedures in the areas of performing scenario-based cyber exercises, which can range from social engineering, tabletop, or cyber range. And these are just testing methods that vary in terms of approach, complexity, and scope, and also cost. And these tests should be performed on a periodic basis. So tabletop would probably be the least complex, and what you would be able to perhaps to organize on a departmental or non-organizational level, and that can extend to a cyber range, where you're looking at your whole type of environment from end to end, where you have third parties or outsourced relationship, and testing in that particular scenario where you're coordinating across multiple entities. Additionally, improvements can be had from performing adversarial attack simulation, or what is called like red team exercises on a periodic basis. And that just represents a current evolution of what you perhaps would be familiar with, penetration testing, but it's more comprehensive, where penetration tests may concentrate on a particular system or an application. Red team testing would focus on the sort of the entire infrastructure, and it would involve less notice with the internal teams and can take a very long period of time, whereas a penetration test, you might give the internal IT team some notice, and the duration may be a couple of days to a week. Red team tests can perhaps go on for several months once the authorization is given. However, those are quite costly. Leading methodologies currently in that area are from the UK, where they have something called CREST, and out of that has been further leveraged through the Netherlands and now deployed European-wide, something called a TIBA EU, which stands for Threat Intelligence-Based Ethical Red Teaming. So the responses in the survey and their subsequent analysis have provided useful information on the current state of play of technology risk management across the population of entities supervised by the central bank. The two primary objectives, I would say, have been achieved, and in the process, strengths and areas for improvement across SFIs, subsidiary groupings, and pairs have been identified and noted for further analysis where warranted. The survey has been extremely useful by providing points of focus and other details in the update of the current technology risk management guidelines. It is the intention of the bank, the central bank, to share the updated draft of the guidelines that were informed by the survey responses for consultation with SFIs in the shortest possible time. The central bank restates the objective for the updated technology risk management guidelines to be of increased usefulness to the sector, providing additional guidance on mitigating emerging risks related to technological improvements that licensees seek to leverage to be innovative and enhance the experiences of their clients and customers. Continued emphasis will be placed on the size, level of complexity, and risk faced by SFIs. In conclusion, striking a balance between regulation and encouraging innovation is a dynamic and ongoing process. As regulators, we must remain vigilant and adaptable, continuously updating our frameworks to keep pace with certain technological advancements. By doing so, we can foster an environment where innovation thrives, consumers are protected, and the financial system remains stable and secure. Thank you for your attention, and we look forward to our further discussions with you.
Thank you again. Ladies and gentlemen, please, let's give them another round of applause. I thought the material is really, really good. And now that they've wet your whistle and got you thinking a bit, we turn over to the second stage, which is where you get some of the questions. But I'll lead it off, and I'll invite our esteemed lecturers to answer. They can take them as they want to. So what do you foresee as the biggest challenges in implementing a regulatory framework, sand dollar, for a small island regulatory agencies such as ourselves? Sandbox, all right. Do we have a mic, or do they walk up? You can. So what is the biggest challenge you foresee in implementing a regulatory sandbox?
Thank you, Errol. I think one of the challenges is ensuring that we cover the breadth of potential licensees. I think we'll see some innovation that may skirt the lines of banking, but also some security activities, and so we have to ensure that we have the capacity to understand these things as they develop, and when they come through the particulars and provide the particulars of their business for the sandbox, we have to be able to engage with them and have an appreciation for this information. So I think that the biggest challenge is having an appreciation of what this innovation technology, what evil is it trying to cure, in terms of providing some or filling some type of gap or providing some type of service to consumers. And so that appreciation has to be always discussed with individuals like John, who's well versed in areas of understanding the technology capacity, and of course liaising amongst ourselves and of course our regional and international partners. And so that sharing of information allows us to be well versed in a very quick time while potential licensees go through that process of the sandbox.
So I'm happy you called John's name, because the next question is really for him. So everyone's aware of, in a few minutes, everyone's aware of last week's global IT outage. And the question now is, given our work towards implementing this sandbox and obviously encouraging innovation, has that changed the parameters around the work that we have, or things that we need to consider with this deployment?
I think the recent incident has just crystallized sort of what has been anticipated in terms of some of these technology enablers. In this particular instance, where you have a concentration of users in a single globally spread, cloud service provider. So I think, as a subsidiary part of that, you're outsourcing, you have third-party risk, and it just emphasizes certain elements that you have to be prepared, you have to have contingency plans, you have to have incident response plans. And, as we conduct the postmortem and look, you're starting to see possible implications of perhaps having like a multiple cloud strategy, just to make sure that, you can survive depending on your particular business recovery time objectives. These certain disruptions which are going to be part and parcel of the future financial landscape.
I see we already have a question in the audience.
Well, you asked one of my questions. And my other question is, with the sandbox, how is it different from the framework that companies report to the central bank, and that system that they're reporting out? How is that going to be different from that? What's going to be new?
I guess they talked about arms.
Okay, so I guess I was just seeking a bit of clarification in terms of the system you mentioned that institutions are using now. The banks, the banks report their quarterly. Okay. Okay. Yeah. How is that going to be different from the sandbox? Yes. Okay. All right. So the ORMS portal is really a tool, a platform that financial institutions use to submit data and other, regulatory returns to the central bank. So it's really just a technology tool that the central bank uses to receive information from our supervised financial institutions. The sandbox essentially is an enabling environment that would allow financial institutions to test. So essentially, the central bank is creating an environment where we would kind of green list institutions, whether they're regulated by us, whether they're licensed by us or not, to test new technology, new services, new products that they want to bring to the market. And this would allow them, particularly for new entrants, why this becomes important, because you're not licensed to do certain things. So if you're not a bank, you're not a, say, you want to do banking-like activities, but you're not licensed to do that. And so you're prohibited by virtue of the act, the regulations that are in place today, to do certain things, to receive deposits, to test out your technology. And so the sandbox creates this environment where you have this kind of closed loop where you could test that with certain counterparties to see that you've kind of worked out all of the kinks before it's kind of sanctioned as market ready. So it's really just a framework that allows an institution to operate. So it's not necessarily a technology platform like Orums. It's just really having the requisite approvals and along with certain parameters that would guide under which those approvals are issued for institutions to operate and conduct testing, and to ensure that they're market ready before it's released to the public. So Carl is telling me to use the word incubator.
Any other questions? Sure.
Be a part of the sandbox. So can the panel speak to some of the restrictions that would be, I guess, applied to the fintech companies that is going to be a part of the sandbox?
So when you refer to restrictions, you mean in terms of their capacity to not operate in the already established financial system? So what the sandbox is going to permit any entity coming in, any fintech entity to do is coordinate activities in this incubator, and they will not be able to engage with the consumers directly, at least in the very first instance, before they complete some level of testing. And so that is something that we're trying to work out once we get some feedback from the public in that regard. So we will see exactly what's the appetite for that. They won't receive a license, so they're not actually doing license activity. They'll receive an approval letter to be sanctioned to operate within the regulatory sandbox. And so those are some of the general restrictions in terms of what they'll be able to do. Now, having an appreciation for, like I said earlier, what type of product or service that they're delivering and whether or not it is an activity that is currently captured under our licensing regime gives us an opportunity to figure out whether or not this will continue through the sandbox and at the end of the sandbox be licensed under some perhaps enhanced licensing regime or something like that, something to that effect. It is through the sandbox where we get to develop, where necessary and where appropriately, other forms or other streams of licensing regimes where we say, if it's not captured by any other regulator, of course, we'll begin to develop these things in legislation and policy. So I hope that answers some of what you're asking, but there's no restriction in terms of what they're actually doing in terms of in that sandbox. But I see John wants to add something to it.
I'll defer to policy in this particular area, but I think just to share some of my general sentiments, I think it's a good point that you're raising for the discussion. And in that, we clearly define like the expectations and the parameters and define what we're going to allow in the sandbox and who we are going to allow in the sandbox. I think there is a confusion depending on, if you look at it from a technology perspective, there's a historical interpretation of a sandbox which can be like an environment where you're just doing like IT development and like testing out software, which my personal view is I don't think like that should be an element that we include in the sandbox. In a regulatory sandbox, I guess from like my experiences is you develop a product, an innovative product, and it should be market ready, and you are just testing it with in a sort of controlled environment with a limited set of users with the appropriate sort of risk appetite and tolerance, and perhaps a temporary relaxation of some of the strict regulatory rules. But I think it's important, yeah, that we give consideration as to who do we want and how they should use it, and obviously share that with potential applicants as well, too.
These have been some excellent questions. Are there others? Lee. Oh.
What's the need? Why is the regulator driving this? What's the need?
I guess if you look at sort of global regulatory practices in some of the largest jurisdictions, it's provided a sort of unique forum, like I said, to test out some of these innovative products in a sort of a closed, controlled environment. I guess innovation would be relative, and I guess looking at leveraging our national spirit and the abilities that we have, I guess we cannot exclude the possibility that we may have like a new product or in terms of financial services. But I think it's generally been used, and it's as I indicated, one of the elements of that fintech tree, because these are new developing technologies to test them out in a controlled environment. In our case, it may not be completely reinventing the wheel, but it may be useful where we have the first or the local application of some type of innovation which has been tried and tested someplace else. And as we try to roll those products or services out in our local market, the regulatory sandbox might be the vehicle where we test that and kick the tires as well too. So it doesn't have to be, completely original, but looking at it from a relative perspective, you're harnessing innovation in a controlled manner.
I have a question, John. Also, too, although they will have parameters, will there be an examiner like yourself to spot check to make sure these new products and services are successful before they are licensed? Who will be monitoring the testing to make sure it is successful or not before going into a wider framework? Well,
it may not be necessarily like the examiners, but I think you're right. You need appropriately qualified and competent individuals to sort of make that assessment. And I would also add as well, the experience of regulatory sandboxes has been, you may have somebody go into the regulatory sandbox and the product is never released. It's just tested, the results are looked at, and for whatever reason, then it never goes to the wider market.
And secondly, will we require reports or data to see the success or failure of the products before administering a license?
I'll let Carl, but I'd imagine yes. You would want it to be a formal process. You want it to be structured. Yeah.
So just to build off, I think that was I think that's Michael in the back there, right? Hello, Michael. I think what's important is also to understand is the fact that we want to capture some level of unregulated activity that may be happening. And in order to capture some of that, we recognize that there is a material reliance on third-party service providers. So in today's environment, while you may have financial institutions that are offering these products, they're not the ones that are going to be developing them in-house. They're actually outsourcing these to other third-party service providers. And so in doing that, we want to ensure that if they are doing any quote-unquote bank-like activity that that's not captured in our licensing regime, but it appears and has all the flavors of banking or payments, we want to be able to say, you know what, you have this reliance on this third-party service provider. You're seeking to conduct an activity that's not captured in our act or regulations. If you participate in the sandbox, we have an opportunity to either regulate that activity, or we have an opportunity to, that activity can be captured by someone else. As it relates to, I think, Tricia's question, we do, when you look at the consultation paper, it outlines a particular committee that is made up of individuals of varying capacities that will look at the applicants in the sandbox, and they will have the capacity to see whether or not, through the testing environment, through the reporting requirements that are going to be placed on them, because they're going to be conditional requirements, and they're not general in terms of generally applied. They're going to be specific to an entity that is applying to be in that sandbox and participating in that sandbox. And so we're going to have varying personnel to review that. So that may involve both internal and external, and based on what activity is being proposed through that sandbox. All right.
Hi, I have a question. I understand that you open up the doors for fintech innovators to participate. Does this only covers people locally, or is this internationally? That's one question. Secondly, I want to know, with regards to the ISO 20022, does the sandbox also covers that? Because I noticed in your diagram you have the open banking concept. So I'm also a fintech innovator. I've innovated numerous applications and products, but I want to see if I can be able to integrate certain products like the Sand Dollar into a Amazon environment or another different type of platform.
Yeah.
I think that's,
yeah.
This question is for John.
Yeah, I know John. Yeah, John will definitely take some of that. But I think what's important in terms of the sandbox environment, firstly, I'll encourage you, once it's released, please read it, provide some feedback. And I think that's the way we get an opportunity to see whether or not we've ticked all the boxes in terms of applying general understanding and specific understandings in areas where we don't have all of the knowledge. And this is where you as individuals and participants in that space get to feed into that process. And so that's the first thing I would encourage you. So once that is released, please provide your feedback. Secondly, I think the sandbox is going to be open to users who, of course, satisfy requirements to operate in the environment. Okay. So I think that's first and foremost going to be crucial to the participation, because some of them may be already existing entities, but not regulated entities. And so we want to ensure that they satisfy those requirements. As for the ISO 22002, I let John answer that one.
No problem.
Could you further define that particular one for me?
Well, it's more of the enhancement of the existing SWIFT network that we currently have for most banks use in terms of payment operations, and it has enhanced the global cross payments. I mean, the global border cross payments. So it makes it much easier, and also from a digital aspect, with regard to XRP, they taken on that same framework, similar to what Bank of America is doing, in terms of being able to send millions of dollars within seconds.
Okay, yeah, interesting stuff. I would say we as we look to develop this, we perhaps would have to creep before we can walk, and then walk before we can run. Certainly not to discourage you, from your vision and thinking globally, but I think initially you're looking at like cross-border payments and outside of the jurisdiction, which would perhaps be additional layers of complexity, which maybe somewhere is off. You spoke about open banking, as I'd indicated as well too. We structured the presentation on, you can't ignore what's happening globally, but then all of those elements aren't certainly reflected in the local market. And I think like open banking, as attractive and I guess consumer friendly as it is, perhaps maybe some way off our sort of local jurisdiction. but keep pursuing those objectives and those dreams, and see if you can make a difference in that space, and we will attempt to catch up with you.
Thank you.
Any other questions?
I could just add a little, I guess, bit of context to the ISO 20022 program and the testing that's ongoing. As all the banks would be aware, I think everyone is currently involved in making sure that they're ISO 20022 ready for both the cross-border and what is about to become the domestic requirements for the rich text format that's required for SWIFT starting in 2025. So while the regulatory sandbox might not be specifically focusing on that particular element, there's a lot of testing happening both in the central bank with the local closed user group and with all the international agencies, both that are running their operations domestically and through the cross-border program. So if you are working on ISO 20022 and you're not a part of the closed user group testing program, then you can certainly reach out to us. I think someone from FMI might be here right now who can assist with at least helping to see where you're at in that program.
Thank you, Deputy Governor Rolle. Any other questions? Okay. Sorry. So, ladies and gentlemen, what an exciting lecture series. Wouldn't you agree? So let's give our panelists a round of applause again. They say it's good to keep good company, so I'm happy I'm at least here, so I play the part as being learned like my colleagues here. Give yourselves a round of applause for staying behind and participating in this. Certainly, your participation and your questions help to make this event such a success, and we want to thank the team that put this together, including our staff and vendors. We invite you to stay behind as I close. We have not only this wonderful exhibition on our currency, our banknotes here, but we also have some light refreshments for you to enjoy. Thank you all and enjoy your evening.